Welcome to today's webinar on estate and gift taxes. Where are we at and where are we going? I'm Dr. Adam Kantrovich. I'm an extension specialist of agribusiness and agribusiness team leader at Clemson University, and I am joined by Mr. J.C. Hobbs, associate extension specialist with Oklahoma State University. We would like to acknowledge that today's webinar and a lot of the work that we are doing is based upon work that is supported by the U.S. Department of Agriculture under an agreement with the National Farm Income Tax Extension Committee. And we appreciate their collaboration and partnership. It's a 3-year USDA FSA funded project. It covers the topics: tax and asset protection related educational materials for beginning farmer ranchers, commercial farmers and ranchers, socially disadvantaged farmers and ranchers, landowners, and others. The project leaders are Dr. Ruby Ward at Utah State, myself, Adam Kantrovich at Clemson University, and Mr. J.C. Hobbs at Oklahoma State University. You may find out further information about our team, our committee, our project, and additional materials at ruraltax.org. A few important items to remember about this is not formal legal or tax advice, and the material presented is for educational purposes only. We will not be able to go into any detail in any area during this time. This is a general overview. Each situation is unique, and what may work for one individual may not work for another. So make sure you're working with a good team. That should include an attorney that specializes in this area, a tax professional, financial planner, advisor, and possibly third objective party to assist with the process. Just because you may have developed a good plan and have followed all the basics, that does not mean the plan will guarantee success. All tax information used is applicable as of December 11th, 2023, and may change at any moment dependent on Congress's actions, court cases, and additional guidance. Today's topics that we're going to discuss include capital gains, present estate and gift tax laws, tax challenges, resource links, and our contact information, and questions and answers. So we'll begin off. How do you acquire an asset? There are multiple ways that we can acquire an asset. One, which most people think about, is we can buy that asset. We can receive it as a gift from someone, and this is typically done within families between a senior generation and a younger generation. Assets may be inherited through an estate after somebody passes away, and of course, steal it. And I know a lot of people sometimes chuckle with regards to this, but we have seen in various contexts, essentially theft being used to acquire an asset. And under IRS code, technically, the value of assets that are stolen is still reportable. Typically, when we are talking about various tax issues and we are preparing for succession planning and estate planning, we may use, not necessarily steal it, but we may use some functions where we sell property to the next generation. We may gift some of those properties and inherit and allow some to pass through the estate so that the next generation can inherit that. So let's start off talking about long-term capital gain rates. Many of the assets that we're talking about are typically what are considered capital assets. JC, can you please explain to us a little bit so that individuals don't get confused? What is a capital asset versus just something that we purchase that might be deductible in that particular year?
A capital asset is an asset really used in the business or in the production of our items from the business. It'd be like our breeding livestock, our machinery, equipment, things that we're going to have and use for a period of time. They're not the items that show up on the tax return that we've grown. That would be like crops, baby calves that we've grown into yearlings, etc. So these are long-term. The capital gains are or capital assets. Again, that is what we use in the production. So that's your land, your buildings, machinery, equipment, breeding animals, etc.
So including improvements to the land as well, correct?
Correct.
Roadways, wells, fence line, etc. And so the reason why this is important is because we typically do have a turnover of those long-term capital assets. Whether I am a beef, cow, calf rancher, I might be culling some of my cows and if they were raised, etc., or purchased, those are considered capital assets because those are used in the production of something that I am in the end going to sell, correct? The same thing with my land. It might be a tractor that I sell, a used tractor that I sell because I'm going to replace it. And so it's important to understand that there are long-term capital gain rates, which are different than short-term capital gain rates. And how long do I typically have to hang on to something to receive a long-term capital gain rate for something that I sell?
For most of our items, it's more than 1 year. Now, for breeding livestock, or it can change, especially in the way of cattle, you've got to hold on to a breeding cow for 2 years before it gets capital gain treatment. So it depends upon the asset, but typically it's more than 12 months or more than 24 months.
And with that, so short-term capital gains are typically treated at your ordinary income tax bracket rate and not subject to self-employment tax. Long-term capital gain rates actually has a better tax rate. And so it's really important from a management standpoint to consider that as part of your tax management strategies. And as you can see here, when I have income, if I am a married filing jointly in the 2023 year, and so myself and my spouse sell a capital asset, and as long as our total income is under that $89,250, any of the income that was received from the sale of a capital asset that was held long enough between that selling price and where my normal income is at and that 89,250 will be taxed at 0%. And you can see how that increases that tax rate between 89,250 and 553,850 to 15% and 20% above that 553,850. It's important to note that certain items that are considered collectibles, like art, baseball cards, etc., actually have an additional tax rate of 28% versus the 20%. You can see how the capital gain rates do change from year to year based on the rate of inflation, and the IRS puts that out usually in the fall of every year just prior to the new tax year beginning. Tax basics. So as we just a couple slides ago discussed different ways that we can actually access new assets. When we buy it, my tax basis, and tax basis is a very important ideal that we need to understand as it relates to taxes, especially for our capital assets. The tax basis in an item that we purchased is typically the purchase price plus any other costs of acquisition. Now, that being said, JC, is there that cost, i.e. the purchase price plus cost of acquisition, is that going to remain my tax basis from now on moving forward?
That will depend upon the asset. For example, some assets are depreciable. And if they are depreciable, you must take the depreciation according to the IRS rules. So the tax law requires you to take allowed or allowable depreciation on those assets. So that would be your machinery, your equipment, your buildings. Land is not a depreciable asset. So depending upon what's going on, your depreciable basis or your tax basis can change. If it does change due to depreciation, it's called adjusted basis. And with your machine or your land, it will and can stay the same unless you make additional improvements over time.
And this is where we start hearing the terminology of unadjusted tax basis or adjusted tax basis. If I receive an item as a gift, JC, what really happens? What's that tax basis for me?
The tax basis when you receive something as a gift is the same as the person that gave it to you. So if you receive a piece of equipment and the tax basis was adjusted basis was $10,000 in the hands of the giver, then your tax basis in that piece of equipment is going to be the same. It's going to be $10,000. So that when you sell it, then you're going to have to pay capital gains tax based upon those types of situations. The only time your basis is different from the giver to the receiver is if that asset has changed in value or by going down. It decreases in value, then you adjust it accordingly. But if it goes up or has gone up, then it is the basis in terms of the holder that gave it to you.
And so this brings up an important part. We typically don't like to ask for things, especially if somebody was kind enough just, to give us a capital asset of some type. But if there is some significant value in that asset, it is important to ask the individual that provided you that asset as a gift to see if they would be willing to provide you with any of their tax documentation that proves their tax basis. That way, if you turn around and sell it, trade it in, whatever it happens to be, you have some proof of what that tax basis is. And JC, what happens if I don't have any of that information? I can't prove what that tax basis is.
If you can't prove it, you have to use a zero. So its tax basis on your books will be zero.
So the IRS essentially says if you can't prove basis, it doesn't matter. The tax basis is then considered to be zero. If we inherit an item through an estate, typically there is a step up in tax basis to fair market value as of the date of death. So JC, what does that mean?
That means when you receive something through an inheritance, the value of that asset is stepped up because of the fact that the person that passed away, they have to file an estate tax return. The estate tax return shows how much they're worth, and they pay estate tax based upon a series of numbers in that. And if they pay, by doing so, then the value of the assets that are transferred to the heirs or the beneficiaries are then stepped up to the fair market value as of the date of death, or as in some situations, an alternate valuation date that's 9 months after date of death, depending upon what's going on. But basically, it's the fair market value of that asset on the date of death is what the basis is for the person that inherits those items.
So what do I have to do to be able to prove what the new basis is, what the fair market value is as of the date of death? What is acceptable under IRS guidance?
Well, if we have to file an estate tax return, that estate tax return will have those values. If that's not required, it is often, and depending upon, again, the assets, what we're dealing with, it may be wise to have a certified appraisal on those assets so that we know what the value is on the fair market of the date of death. Those are really the best ways of doing so. But there are other ways around this, depending upon if it's inherited by a spouse, then you sometimes don't have to go through a formal appraisal. But it is wise to do so that we can get a better handle on what that fair market value is.
And the last item, of course, that we discussed was stealing it. And of course, if you steal it, there's nothing into it. And so the tax basis is zero. So, and we have to understand this because in many cases, the assets that any individual typically has been gotten through a conglomeration of multiple methods, through purchasing it, through receiving it as a gift, as inherited, etc. And so we need to track all of that information. So now, all that being said, let's begin to take a look at really what are federal estate taxes. The estate tax exemption for 2023 is $12.92 million per person. So JC, what does this mean? $12.92 million. That seems like a lot. It's important to also state that these values continue to increase from year to year based on a rate of inflation, or they could stay flat. And I guess in theory, they could go backwards, although I don't remember any of them going backwards per se, at least in recent memory. But what does this really mean? $12.92 million per person.
12.92 is the benchmark or base of when we have a taxable estate. If our total estate, fair market value of our estate on the date of our death is less than 12.92 million, then we have no estate tax return at the federal level. Now, this does not mean that you don't have an estate tax at your state or for your state. You got to look at that, particularly some states still have an estate tax, others do not. So, but 12.92 million is basically the amount of assets that an individual can own at the time of their death and not be subject to estate taxes. Anything above that is going to be subject to estate tax at the estate tax rate of 40%.
So, just as we made mention a few moments ago, the 2024 exemption amount or exclusion amount is 13.61 million. So you can see that there was almost a $500,000 increase in that from one year to the next. It's also important to note that because of Tax Cuts and Jobs Act, and if Congress does not make any changes or takes action, that whatever the dollar value is for this particular exemption amount in 2025 or at the conclusion of 2025 will actually be cut in half for the 2026 tax year. So if it's 12.92 million per person for 2023, that means if you're married filing jointly, one spouse passes away, there's supportability rules that we'll talk about momentarily. That really means, in essence, a married couple technically has almost $26 million in 2023 that is available to them for paying taxes. And if we take a look at 2024, it's just over $27 million that we could pass through an estate of a married couple if they both have passed and using portability, etc., with nobody paying any taxes on that. So portability, JC, do you want to describe what portability is, please?
So portability, what that is a surviving spouse has the ability to use the unused portion of the deceased spouse's estate tax exemption. Now it has to be elected on an estate tax return as filed. So when you're using or making the portability election, it is required that an estate tax return is filed for that year for that person. So what it really does is make sure that we have an unused amount from the deceased spouse at that point in time gets carried forward to be used at a future time when the surviving spouse today passes in a future year. And that basis, as I still remember, is stepped up fair market value as of the date of death. So that's what you're looking at. So those becomes the benchmarks for how much is left over, the unused exemption, because the step up in basis is what we're using for the deceased person, and we're comparing that to the amount of the exemption in the year of passing. Here's an example. So in 2023, the exemption is 12.92 million. That's per person. Everybody has it. The total estate value is $20 million. Now, mom and dad each own a 50-50 amount. So each of them own 50%. So mom has 10 million, dad has 10 million. So in both scenarios, they're below that 12.92. So dad dies in 2023. The estate is worth 10 million. That's the fair market value date of death. So the portability of that unused exemption that goes to the surviving spouse is calculated as such. It's the 10 million. That's his estate value, subtracted from the 12.92 million. So the unused exemption is $2,920,000 that is allowed to be carried forward to future years for mom to use when she passes at a later date. So in our example here, mom's going to pass in 2024. The estate has grown in value from the 10 million to 15 million. Everything went up very well. So if you look at where the estate tax exemption is for 2024, it's 13.61 million. Now her estate, if it wasn't for the portability, would be taxable to the tune of $1.39 million. But since she has elected to use portability, she brings that forward. So her estate tax or estate exemption with the portability now, so that's 15 million plus what's carried forward, gives us then 16.53 that's allowed to be used. So essentially, she has no estate tax that's going to be due. Her estate, 15 million, is less than the total exemption amount plus the portability amount of the 16.53 million. So by electing the portability, we can save ourselves a lot of dollars on our estate taxes. Now we get into gift taxes. The gift tax amount is the amount of an individual can give to another person, a recipient, without paying any gift tax. So the annual exclusion right now for 2023 per individual, per recipient rather, is 17,000. So I could give each of my daughters 17,000 in 2023 and not pay any gift tax on it. Now, if I go above that, I do have to file a gift tax return. And the donor is responsible. So me as the giver, I have to pay the gift tax. I have to file the return. Husband and wife or spouses using gift splitting can then in 2023 give 34,000 per person. So my wife and I, setting it up correctly, we could give each daughter 34,000 and not pay any gift tax on that. Once we get above that amount, so my wife and I could give each daughter essentially $100,000. And if we were going to do so, we would use part of that lifetime exclusion, the estate tax exclusion, and that would be used to offset the gift tax that would be due. So we wouldn't have to pay any gift tax, but we would utilize part of our annual or our estate tax exemption in the year that we make the gift. So the 17,000 from the 100,000 means that we have used up $83,000 of our estate tax exemption that is gone forever. In 2024, it goes up. Annual inflation adjustment, 18,000 per recipient is what it's going to be in 2024 and future years until it gets another adjustment due to inflation. So here's a gift tax example. So in 2023, the annual exclusion again was 17,000 per recipient, or is. Mom decides to give a house to the daughter. The fair market value of the home is 200,000. So the amount subject to gift tax is 183,000. That's the 17,000 subtracted from the 200 because she gets an annual exemption of 17,000. She then takes that 183,000 subject to gift tax and reduces her estate tax exemption at 12,900,000 plus 12,920,000. So now when she passes at this point, she would have $12,737,000 of exemption, not to 12.92. So what she's doing is she's making the decision to apply that against the exemption amount so that she doesn't have to pay gift tax. So the rules are, you got to look at your state specific rules because what applies at the federal may not be, well, very well could not be the same as states. And depending upon what state you live in, you may not have any estate tax due no matter what. For example, there's several states that I'm around. I live in Oklahoma. Oklahoma did away with their estate tax in 2010. Kansas did likewise. So depending upon what state you're in, you may or may not have to worry with estate taxes. Adam, back to you on this one.
So we're going to talk briefly about some general succession asset protection. And as we've been discussing, there's an expected estate values that are going to be transferred in the future. And we want to kind of express the importance of succession planning, i.e. estate planning, transition planning, etc. And for many individuals out there, I'm the child of a silent generation. This is that generation that was born between 28 and 45, and they're expected to transfer about $30 trillion. And for those individuals, in many cases, it may be too late to develop a plan, especially if they have passed or their mental faculties are no longer there. But for others that are still around, it's important to revisit your estate plan, wills, etc., and see if any changes need to be made. Then we move on to the baby boomer generation, which is from 45 to 64, and they're expected to transfer almost $40 trillion. And if they have not developed anything at this point in time, you better get started. Then we have Generation X, and they expect, when the time comes between now and 2050, to transfer somewhere above $70 trillion. So it is time to run, not walk, with regards to developing your plan, and make sure that we are planning things for the future and that it's going to remain flexible. And many Generation X and millennials, I am sure, are just waiting for time to pass so that they have the availability of their previous generation's wealth that they can actually maybe retire and enjoy life for a little bit. So what is a good succession plan? Well, one, it provides for the financial needs of all parties involved, not just one-sided. Attempts to maintain family harmony and or between individuals. It creates or provides an opportunity for the business successors, a hand up, not necessarily a hand out. But all of this is facts and circumstances is going to be based around the individuals that are involved, their goals and objectives. You typically would like to have it flexible so that things can change. Nothing stays the same. We can prepare something now, but 10 years down the road, we may be in a very different situation. So you want some flexibility left in that plan. Typically, we would like this to be relatively simple. It does not have to be overly complicated. Unfortunately, in many cases, we end up seeing too many times a very complicated estate plan, and the individuals or the holders of that plan are so confused because of its complications, it never fully gets enacted, and actually could be detrimental to the succession of the farm or agribusiness. And if possible, we would like it to minimize tax liabilities. However, it's important to understand we need to be able to match up and make sure that the goals and objectives that the individuals that are part of this process, to be able to meet those, some of those goals may not allow for the minimization of those tax liabilities, and that's fine as long as we go in with our eyes wide open and understand that. And no matter what, communication is key. Communication is key for those that are successors to the business, as well as to the heirs, those individuals that are not successors to the business, but may still be legal heirs, regardless if the senior generation provides anything to them or not. It's important to communicate your expectations of what's going to happen to hopefully prevent any legal issues that may arise after your passing. It's also important to understand, and we said it up front, sometimes a good plan just does not work out. And it's important to continually review the plan and update it as needed. JC, 5 principles, please.
So we look at the things that we really want to have in place, want to do, and think about. If you don't develop an estate succession plan, there is one that's already been created for you. It's called the Rules of Intestate Succession. And these are state-based rules for how your assets will transfer from you to others. So basically, if you do nothing, something's going to be done whether you like it or not. And it's not really if, it's when you pass. One of the things that we know for sure is we don't get out of this alive. And silence is deadly. Communicate with your heirs, communicate with the beneficiaries, let them know what you're thinking, because it is helpful for them to know what it is that you want to have happen and how you want it done. By keeping everybody in the dark, it makes it very tough for the person that is either the settler of your estate or a successor trustee to know exactly what your desires were. And we have the desire as individuals, we crave options. We want to know if we have other choices, other ways of doing things. So we like to have these options by doing some plan development and visiting with the heirs, your beneficiaries, and you develop the plan. You can make it or tailor it to cover what you want to have happen and help them understand why you're doing things. Because again, those are your assets. You worked hard to accumulate them. You have places that you want those assets to go. You have choices of how you want them to be received. Put that into your plan and make sure everybody understands it. And if you develop a good plan, you're going to minimize your cost of the estate settlement.
And as we stated earlier, there's many methods that may be utilized to develop your estate plan and or succession transition plan. And in many cases, really, although some technically and from a legal standpoint, they are different, the reality is they need to be running parallel and work together. And so it's a good idea that as we are developing our succession and transition plan, that our estate plan is updated and may mention that, and vice versa as well. Typically, although some cases you may have someone say, oh yeah, just give me your stuff and I'll throw it into a template, but it's not necessarily recommended because every situation is very unique and very different to the facts and circumstances surrounding that family and or individuals that are involved with this. And so I know a lot of people want something nice and easy, just give me the template so I can fill in some blanks. That's really a bad idea. And just remember that old physics principle. For every action, there's an equal and or greater reaction. Now, yes, that may not be word for word, but I simplified it a little bit. When I plan on doing something for the estate, whether I decide to gift it, that means I no longer have control over that particular asset. That goes into the next generation. Now, there's some pros and cons to that. By me not gifting something and me holding it back to pass through the estate, I've made a decision about something. There's some pros and cons to that. What happens if? What happens if I can no longer take care of myself? I am in a 24-hour nursing situation on Medicaid. What happens to those assets? So these are some of those considerations that we need to think about as we move forward. Some methods may help reduce tax liability, while others may increase that tax liability for the estate. Just be cognizant of that. The other thing is we need to build the estate plan, succession plan, transition plan based on the tax law of today and or what we know is going to happen in the very near future. But we cannot determine what's going to happen a couple years out, 5 years, 10 years. And so that's one of the reasons to kind of consider the flexibility that can be built in for us to modify and change it if tax laws change, especially those surrounding estate and gift tax laws. So in some cases, due to the need of income by a senior generation, what we are beginning to see right now, one of the methods that can be used to reduce the value of an overall estate is through the use of a conservation easement. And we are seeing more and more of this around the country. That being said, many individuals sometimes go into this not fully understanding all the pros and cons with regards to that, along with the benefits and potential liabilities that may be attached to something like that. And so all angles of this really need to be evaluated. You really ought to work with a tax professional and or legal professional. And sometimes we'll hear another term for these conservation easement, which you'll hear purchase of development rights, PDR, because that's really what's happening. If I have to donate or sell my development rights for this conservation easement, you are essentially doing away with the ability to sell your land or for you to develop your ground for any other purposes besides what was agreed upon in that conservation easement. And it's important to understand that those conservation easements typically are in perpetuity for life. Okay, so what does this really mean? This is an actual sale and or gifting / donation of the future use rights, typically in this case, your development rights of the property. You're giving that up and it's going to be held in perpetuity by a third party. It is just like the sale of land, which may initiate a tax liability. And too many times people go into this thinking that they're going to receive cash and potentially some tax credits from this, which may be true. But because of what you are doing, it also may initiate an actual taxable event. So let's start off with this and why this may create a taxable event. And I want everybody to understand we are not going to spend a huge amount of time going a mile deep in this, but just enough for you to ask the right questions if you are considering this conservation easement. So the first place we need to start with is the tax basis. You may already have an established basis on your property, whether it be unadjusted or adjusted, based on how you received that, i.e. through purchase or through a gift that you received, or it was passed down to you through an estate. Regardless, you may have made some improvements which may have adjusted the tax basis. But in many cases, when we developed that tax basis, we really did not differentiate the difference between the type of use. Okay? And that's what we have to go backwards and do now. And if you're going into a conservation easement, there is going to be an appraisal of that land. And somebody's going to appraise the value of that land and is going to break it apart towards what is the actual development rights value for that property versus its farming value, okay, without development on there. And so now what you're really going to need to do is figure out, okay, what is that percentage? And we may have to go backwards and break out the basis in that land based on that percentage to what would have been the appraised development right value based on that percentage. That's all we can do at this point in time. Okay. And so it's a ratio that you are going to use to kind of reestablish that basis. If you can't establish what the basis is, of course, according to IRS, we've already discussed this, it's zero, which means you may have a very high tax bill on your hands because of the cash that you may have received as part of this conservation easement. So to determine if there is any tax liability, A new basis has to be established based on the value of the portion donated and the amount of cash received for the portion of the property that the PDR was sold. Then the difference between the newly established basis and the previous basis is determined. The difference in the basis may create a tax liability, which should be a capital gain. And in most cases, it's going to be a long-term capital gain, but depending on the situation, it technically could be a short-term capital gain if you did not hold on to the property long enough. Now, it's important to understand, are you a qualified farmer? A qualified farmer for this purpose, farmer or rancher, as defined by the IRC, Internal Revenue Code, Section 170, is at least 50% or more of the taxpayer's gross income is derived from farming. Why is that definition important when we're talking about a conservation easement? Well, it is because we will hear many of these conservation easements tout that, hey, there's a farm, that there may be a federal tax credit for you. And in some states, there may actually be a state credit for you as well. If the contributor, the person that donated the property, is a qualified farmer, then 100% of the value that was donated may be used to offset some of your taxable income. Now, that being said, you're able to utilize 100% of that to be offset, okay? Any value that remains above that. So for instance, let's say I've got $250,000 of land value that I donated. My taxable income is $100,000. I can use and offset 100% of that $100,000 taxable income from that $250 of donated value. Well, what happens to that remaining $150,000? I get to carry that forward for up to 15 years or until it is completely used up, whichever is shorter. So if I use it up in 3 years and we're done, you're done with the credits. If I keep holding out because I can't use all of it until 15 years and I still have some remaining after that 15th year, it goes away and you're done. You can never use any more of that to offset any of your taxable income. If you're not a qualified farmer, then you are generally limited for most individuals to about 50% of the taxable income that can be offset by the donated value of that ground. Now you see there on the slide, I say 30% or 50%, and a lot of that is dependent upon who is going to be that third party, who is purchasing and or you are donating those development rights to determine is it 30% or 50%. And of course, again, any unused portion of the donated value may be carried forward for up to 15 years. And again, there are different rules state by state. We strongly encourage you to determine if there are any other state-specific tax benefits for the state you live in for property that has been donated and or sold in a conservation easement. There are many states that have some credit that are provided to you that may exclude certain dollar values that you receive for the purchase of development rights or for the value of what was donated. And some states even have, not many, but a few actually have a credit exchange that you can enter into and have somebody purchase those credits if you're unable to use those. In summary, JC, I'm going to let you finish this off.
So wrapping things up, you always want to have formal documentation, even among family members. What is said will often be lost. Always work with a tax advisor or legal advisor. My contention is you need both. Many times we have tax professionals that don't understand all the legal ramifications, and we have legal advisors that don't understand all the tax ramifications. So be sure you work with both groups and make sure that everyone involved in this process understand your goals and objectives, what it is you want to have happen. Again, you worked hard to put all this together, and you should have the right to decide how it's going to be transferred. And they need to understand just that. These are what I want to have happen. This is how I want it to have happen. Also, it's very important to go back and revisit your plan. No matter what you do, things change. Laws change. Tax provisions change. Also, family situations change. With the onset of a new grandchild or grandchildren or a piece of equipment or a piece of land being purchased, it's going to impact what's going on. So revisit your plan as things will change. That is inevitable.
And as we said up front, work with a team, and it's usually good to have an objective party that doesn't really have a dog in the fight. Somebody other than an attorney, financial planner, etc. Somebody that is there kind of watching out for you, that you trust, that can also play devil's advocate and maybe even act as a liaison to kind of work between you and the legal and or tax professional. And there are many states, not as many as there used to be, that have individuals like a J.C. Hobbs or myself and others that cooperative extension kind of helps move you through a structure and system to develop a plan and then go to the attorney. And with that, here are some resource links that you can find at our ruraltax.org website as well as farmers.gov website. If you have any questions, please feel free to go to our ruraltax.org, and we have a link there that you can send an email, and that will be provided to an individual closest to the state that you are from, and or to an individual that specializes in that topic area. And again, we appreciate your time here today watching this webinar. I am Adam Kantrovich, and I was joined by J.C. Hobbs.
Thank you for attending with us.